Hey guys, welcome back to the Wealth for Real YouTube channel. I'm Chris Anastasio, your host. It is Tuesday, May 9th, 2023. And what I wanted to do with this video, guys, I'm going to kind of walk through something with you here real time, this tab over here, this article from The Real Deal. But I just want to point out that the video I'm about to make for you guys on this article, I actually did a Facebook Live yesterday where I was just kind of giving sort of a hot take, sort of an immediate reaction type thing to it, which you can see here, just driving in the vehicle. So this is kind of like, you might want to watch this. I mean, I wouldn't say it's necessary, but this is the Facebook Live I did here, and I actually reposted it to the YouTube channel as well. So it's going to be on YouTube too. So you may have seen it there already. But sometimes, just a note, guys, I will do that. I will jump on Facebook Live and talk about something sort of like a hot take before I get a chance to, let's say, go like line by line or section by section through an article or some kind of reference document or reference point that I want to share with you guys. So anyway, just want to point that out to you. There it is from yesterday, and then I reposted it to YouTube today, the Facebook Live. So here's the article I'm talking about, guys. This was something I saw. I was just browsing Instagram. Came across the Real Deal's account, and it had this whole thing about the Widowmaker. It had this image, and it was link in bio, whatever. Went over there, found the article, and so went through this thing in chunks. I can't say I read every single word of it. I will eventually do that, but I didn't want to delay on making this article for you guys because this article is actually from May 1st, so it's already 8 days old. Top level, this article is about Wall Street, hedge funds, traders, institutions, whatnot, who are betting against offices or commercial real estate properties that fall into the office category, and how it could be the next big short. Of course, big short referring to 2008, betting against the housing market, betting against residential housing market. That was really the big short, the Michael Lewis book, the movie, et cetera, et cetera. So that's the sort of the slang here is the next big short, where these institutions and entities are betting against offices, commercial property, and why it's so risky. So it was a really interesting article, guys, because of two things. Number one, it's kind of dealing with this question of, from where and how is this next big domino going to fall that topples the economy, right? Like if we assume we're going to have a 2008 style event, right? If we're assuming, if you're in that category, I know I see people online all over the place who just flat out don't think anything's going to happen, think everything's going to be fine and turn back around, bull market keeps going, that kind of thing. That's fine. I'm not in that category. I could be dead wrong, right? I'm in the category of we're going to get another 2008 style event. We're going to get another Great Recession style event. Okay, so on that premise, how's it going to start? Where's it going to come from? And one of the big things you hear, the two big things I've heard are it's either going to come from commercial real estate, that real estate market this time, and or from this shadow bank situation. These banks that are not true banks, they're non-banks or shadow banks, whatever term you want to use, and they have totally different or really no oversight or regulation in place like regular banks have. And that could be the first domino that falls, or that could be a contributing major factor, right? So those are the two things I've been kind of like, got one eye on each of them, right? So this article talks about the first one, the commercial real estate issues. But what's really interesting is it gets kind of technical, and this is more the second thing, I guess, that it kind of delivers, and it's maybe more geeky, but it sort of talks about the exact like trade that's being made here and some of the intricacies of it, some of the complexities of it that could actually turn that big short, that maneuver, into the Widowmaker. And the Widowmaker, actually, I'm going to skip down here, guys. I didn't realize that they were actually referencing this exactly. Let's see if they even have the picture in here. Yeah, here we go. So in actual biology, a Widowmaker is when you have the Widowmaker is a nickname for the left main coronary artery, a frequent cause of fatal heart attacks. Okay, so that's actually the biological definition of a Widowmaker, and in this case, they're using it obviously as slang for something that could blow up these institutions, these traders, these hedge funds who are making this bet against offices. Okay, so those are the two things that I thought were valuable about this article. Again, the second one not maybe as much as the first. If you really want to keep it macroeconomic, it's an interesting article nonetheless. So a couple things I just wanted to show you guys in here. They start off with this anecdote about Eric Yip. His hedge fund, Alder Hill Management, was shorting. So this is the technical thing I was telling you guys about. CMBX, the commercial mortgage market's answer to the S&P 500. So that's if you hear me refer to CMBX or the index or whatever, that's what I'm talking about. Is CMBX is this sort of representation of commercial mortgage market, like the S&P 500 is, as a basket of companies and so forth on that index. So anyway, so it says that Alder Hill Management was actually shorting CMBX, but not for offices, for malls. Okay, so they were focused on malls because of the whole shift to Amazon, shift to online, shopping and so forth, and so they bet that malls were going to perish. Okay, but it took longer than Yip accounted for, and in 2019 he had to shut the fund down, and the whole thing kind of blew up on him. The problem was that it could have waited a little bit longer when COVID hit. Just like 1 year later, he would have reaped riches from that trade. So the Widowmaker, an esoteric corner of the securitized mortgage market that seduces gamblers with the siren song of the next big short. So you see here, guys, and again, this goes to the macro forces at play here. The existential crisis this time isn't in malls. It's short sellers placing billions of dollars worth of bets on CMBX, the belief that remote work and $108 billion worth of securitized office loans that will mature in the next 5 years, I assume they mean between 23 and 28, will wreak havoc on bondholders in the overall market. So this is kind of, if you're looking for the macro takeaway, this is the thing here. Okay, you can see here, they're saying it looks like a good bet. You have, office buildings going to default, or lenders unable or unwilling to refinance the debt that are on those office buildings. So that's kind of the crux of it with regard to what's the macro issue here. It's that you've got remote work and $108 billion worth of securitized office loans maturing in the next 5 years, right? So put those two things together, and think about how that issue could perpetuate and spread like a contagion throughout the real estate market, the banking system, and the economy as a whole. Okay, so here's where it gets a little more on the wonky kind of tactical side. It actually starts talking about CMBX and the guys who trade this thing a lot. So it says here, nailing the short requires an intimate understanding how these trades work. Even the most thoughtfully planned trade can be undone by the various parties, special servicers, bondholders, even outside meddlers looking out for their own interests. Real estate's tendency to extend and pretend its problems for another day can stretch timelines from months to years. The tricky technical aspects of CMBX can wreck a position long before loan-to-value ratios or maturity dates come into play. So that's the technical sort of machinations of investing or shorting CMBX, is that you may just run out of time, right? Real estate is inelastic and takes a long time for things to really blow up. So you may just not be able to hang in long enough to reap the reward from a correct guess that the market was going to come down. So there's a couple other interesting things I just wanted to show you guys here. Okay, out of office. Okay. CMBX series of mortgage indices came out in 2006. 25 CMBS deals representing different types of properties, malls, offices, apartments, more, sliced into tranches of debt. So this is what I thought was interesting, guys. Take a look at this right here. And this is where the real deal kind of veers off course, and I kind of disagree with their reporting on this. The safest slices of CMBS, the AAA tranches, are used mostly for mundane risk management. Riskier pieces, BBB minus, rated above junk, is known as a Widowmaker. Okay, on the face of it, I got it. The issue, guys, is if you remember 2008, you remember that the ratings meant jack shit. They didn't mean anything. A AAA rated tranche in the housing market situation from 2008 was just as bad in many cases as BBB minus. I mean, it was rating agencies who are not fiduciaries. They have no obligation to give you good information. They're simply being paid to rate these securities. They just went to the highest bidder. The highest bidders got AAAs. The lowest bidders got BBB minus. I mean, I may be equivocating there a little bit in terms of exactly how they betrayed us. But the bottom line is they had no obligation to us to rate these things correctly. Okay, so my point is, how do we know they're rating them correctly now? Maybe the triple B minus tranche is dog shit, and they've correctly rated it as such. But maybe the triple A is also dog shit. Maybe the triple A tranches of CMBX are not safe either. So what you see is you have a situation where we're thinking, according to this Real Deal article, that if you're triple B minus, you're at risk here. But if you're triple A, you're fine. What if nobody's fine? What if the whole thing is a problem? What if the whole thing is vulnerable? And what if the whole thing comes down? So this, I thought, was a really interesting point here, guys, that Real Deal was making that I disagree with. I don't think you would want to say the safest slices, AAA tranches. I don't think you use that terminology anymore on a rating like this because there's no such thing. And quite frankly, guys, and I haven't done enough research on this, I don't think Dodd-Frank fixed the rating agency problem. I think they talked about it. I think maybe there's some language in there about it, but I don't know if they actually fixed it. Okay. So anyway, that was a big point I wanted to make to you guys, trying to keep this under 15 minutes. This is an interesting quote here. You need the entirety of commercial real estate to fall by 25% in valuation. It feels like a lot, but maybe because of this, the whole AAA issue I just went over, maybe it's not a lot. Maybe 25% is quaint, and the whole thing, or close to the whole thing, is going to come collapsing. Okay. So anyway, they go on down here, guys. This is where I didn't read as much. So I really need to catch up on this word for word. But they really start talking about the net value of the bets on the triple B minuses. They talk about this hedge fund here. It's got a $22 billion investment. Pulpo Capital looks like they've got a short on this as well. So they're talking about the bets that were made here and who's exposed. And if they get their timing right, these guys are going to be the Big Short 2.0 winners, basically. Let's see, they go on to talk about some of the other guys that got blasted by investing in this too early. Okay, so here's the other thing I wanted to show you guys. Okay, an investor who wants to short a CMBX index enters into a credit default swap with someone on the other side who wants to go along, similar to an insurance policy. The short investor pays a premium, and the other side compensates them if a borrower in the pool falls short on interest payments or can't repay their loan. So here we are, guys, credit default swaps 2.0, right? The CDS issue was at the heart of the matter in 2008. Sank everything in 2008, and here we are again we're talking about credit default swaps, and and the fact that this is how these transactions are kind of taking place. Okay, somebody's saying, I want to short CMBX. I'm going to buy a credit default swap. I'm going to buy insurance. I got to pay premiums each month for that insurance. The other side compensates them if a borrower in the pool falls short on interest payments or can't repay their loan. So if somebody blows up, there's somebody on the other side of this CDS transaction that's got to pay out. Do we know if all those individuals can pay out? Do we know if all these counterparties, right, when they say the other side compensates them, are all these counterparties liquid enough to pay these CDSs? If this whole thing blows like I was talking about up here with the AAA versus triple B minus situation, right? What if those AAAs are garbage? What if the whole thing goes down? Can all these CDSs be repaid, or are we right back where we started in 2008, like AIG paying scores and scores of CDSs that they couldn't afford to pay because they didn't have the liquidity? You guys see where I'm going with this? So these were the two sort of specific points in this article that I wanted to kind of show to you guys. I'm going to wrap this thing up, actually, get under 15 minutes. If I see more in here, I'm going to make another video. But those are the things I want to give you guys at the top line. Commercial property, mortgages, macro, CMBX on the technical side. Those are two big things you'll take from this article. And then specifically the rating agency issue that I talked about further up the article, and this credit default swap issue here. They both are reminiscent of 2008. Did we fix, the big questions here are, did we fix the rating agency problems from 2008? Probably not, but I got to do the research. Did we fix the credit default swap liquidity issues and regulation from 2008? Probably not. And don't get me wrong, there's probably language in Dodd-Frank about both of those. I bet they don't fix the problem. I bet they don't actually fix the problem. Okay, guys, so thank you for watching this. Drop a comment or a question. As I go through this article some more, there may be more videos on this, but I really want to get this out to you guys.